Again, good morning. So this is lesson 2 on relevant costing. So we will be discussing decision situations. So here, one of our profession is to become a managerial accountant or a management accountant. So being a management accountant requires one, to provide the necessary mathematical and numeric support to the instinct or gut feeling, no, of business managers and marketing managers. So the management accountant will provide the numbers or values required to justify the management's decision, especially when large amounts are involved. So these are, for a recall, the following basic steps in dealing with decision problems. So first, we define the problem. What is the problem? Is it a make or buy decision? Second, establishing a decision rule. So what if there is a make or buy situation? How do we make a decision? So what is the ruling? Third, identifying the alternative courses of action. Fourth, determining the consequences of the action. Fifth, evaluating each alternative. Sixth, choosing the best alternative. And seven, making the decision. Okay, so we have a make or buy decision situation. So the question would be, should we make an item or purchase the item? Should we perform the service ourselves or should we avail of the services from a vendor? So how do we decide? So what is our decision rule? So our rule would be to buy if relevant buy cost is lesser than the relevant make cost. And we will make if our relevant buy cost is greater than our relevant make cost. So it makes sense, no? So baga, bottom line is whichever is less expensive, lesser cost, that's our decision. So if buy cost is lesser, then our decision is to buy. But if the cost to make is lesser, then our decision is to make. So that's a basic business decision. Okay, so our data analysis format would be to make a column, two columns rather. For make cost, we have the materials, direct labor cost, variable overhead cost, avoidable fixed overhead cost, and other avoidable incremental costs. For our buy cost, our relevant cost would be the purchase cost plus the handling cost. Then we deduct the incremental revenue or earnings from use of released resources. Okay, so that is our data analysis format. So again, our decision rule is to go with the option that gives us the lesser cost. Okay, so let's check our understanding. So we have for self-check number 1. Question. The opportunity cost of making a component part in a factory with no excess capacity is letter A, the variable manufacturing cost of the component, B, fixed manufacturing cost of the component, C, cost of the production given up in order to manufacture the component, and D, net benefit foregone from the best alternative use of the capacity required. Okay, so we have a problem here, a sample problem. So for example, Mariam, owner of Mariam Restaurant, uses 5,000 noodles per month for its famous soup. So these are the current costs. So we have ingredient cost, 4 pesos. Labor and other variable expenses, 2. So an external seller by the name of Hisham offers to sell Mariam the dumplings at 5 each. So if Mariam would buy those dumplings, he can eliminate 4,000 per month in fixed making cost. So she thinks that she can also earn an additional 3,000 per month in contribution margin by adding 3 tables where the soup has been made. So the question would be, should Mariam accept the offer from Hisham? Okay, so that is our question. So we have here our solution. So again, we identify the relevant costs in each alternative. So first, in making. So if we make, our ingredients would be 5,000 times 4, okay? So that would be, we have 5,000 noodles multiplied by 4. So we have 20,000. So we have labor and other variable expenses. So we have 5,000 times 2. So we have 10,000. So we have the avoidable fixed cost. If we will make, we have 4,000. So we have the total make cost of 34,000. So if we buy, our purchase price is 5,000 units multiplied by 5 peso, the selling price of Hisham. So that will give us 25,000 less the incremental revenue. Okay, so we can add 3 more tables. So that's 3,000 per month. So our total buy cost is 22,000. Okay, so if we make it ourselves, it will cost us 34,000. If we will just instead buy it from an external supplier, we will just spend around 22,000. So again, we are talking here all about costs, no? So for relevant costing and short-term non-routine decisions, we are focused at the cost. So we want that cost to be reduced as possible. So our decision would always go to the alternative that will give us the least cost. So here, the lower, the better. So our decision is to buy because it is just only 22,000 and it will give us a net advantage of 12,000. Okay, so we have another problem. A manufacturer of helmets has been operating at 80% of plant capacity. In order to utilize greater capacity, the plant manager is considering making another component which had previously been purchased for 61 per unit. The plant has the equipment and labor force necessary to manufacture the glass, the covering of the helmet, which the design engineer estimates would cost 14 for raw materials and 30 for direct labor. The plant overhead is 20 per direct labor, of which 8 is fixed. Okay, so how do we analyze? Okay, so again, we pick the relevant cost. For the make, the alternative to make, we have the materials, 14, we have the direct labor, 30, and we have a variable overhead of 12. So therefore, that will give us 14 plus 30 plus 12, we get 56. If we just buy that glass, that covering of the helmet, it will cost us only 61. So again, we are focused here at the cost. The lesser, the better. So we will go with the make alternative, the make option, because it will give us a net advantage of 5 per unit. That's 61 less 56. Okay, so this is how we solve make or buy decision situations. Okay, so now with an understanding of the past slides, please answer on your own. Okay, so Green Company produces 1,000 parts per year which are used in the assembly of one of its products. The unit product cost of these parts are as follows. Variable manufacturing cost 12, fixed manufacturing cost 9, the unit product cost is 21. The part can be purchased from an outside supplier at 20 per unit. If the part is purchased from the outside supplier, two-thirds of the fixed manufacturing cost can be eliminated. The annual impact on the company's net operating income as a result of buying the part from the outside supplier should be. Okay, so we have another decision situation, special sales pricing. Because sometimes in business, um, even if you have regular sales, there are really some instances where a customer will offer a bulk sales but at a lesser selling price. So it's kind of a wholesale transaction. Okay, so many units will be sold but a reduced selling price. So how will we decide? So our question would be, will we benefit from special sales generally made at a price lower than those charged to our regular customers? So how do we decide? So what is our decision rule? So our ruling would be, we will accept the special sales pricing transaction if our incremental revenues is greater than our incremental cost. So therefore, we should have a profit at least. Okay, so our decision factors. First, excess capacity exists with no alternative use of capacity. If we have an excess capacity and we have no plans of using that capacity, so it is better to just use that capacity to cater to the special sales transaction. Second, special sales should not interfere with regular sales. So this is another factor. The special sales should not mean that we are losing unit sales to our regular customers. And third factor, the special sale is a one-time order and will not become a repeat business. Okay, so our data analysis format would be incremental revenues less incremental costs, and we are focusing our analysis if we have incremental profit. So again, on this decision situation, the bottom line is if we have incremental profit, then accept the special sales order. Okay, so we have self-check number 3. Okay, consider a decision facing a firm of either accepting or rejecting a special offer for one of its products. A cost that is not relevant is letter A, direct materials, letter B, variable overhead, letter C, fixed overhead that will be avoided if the special offer is accepted, or letter D, common fixed overhead that will continue if the special offer is not accepted. Okay, so we have here a problem. So we have Ahmad Incorporation can make 10,000 flaglets per month. Ahmad can sell 9,000 flaglets to the local basketball fans for 10 per flaglet. Okay, so the company cost per flaglet based on making 10,000 flaglet is the following. Prime cost 5. So again, prime cost refers to direct materials and direct labor. Okay, so overhead cost, and that's 3. Overhead is 2/3 fixed at that volume, at 10,000 volume. So we have another customer. Okay, so a special customer Ali, offers to buy 1,000 flaglets with special, embroideries or designs for 7 per flaglet. Okay, so again, we are regularly selling at 10, no? The offer is at 7. So printing the special design would cost another 200. Okay, so should this special order be accepted? Okay, so we have here our solution. Okay, so our incremental revenue, we have 1,000. Okay, the special sales offer that will be bought from us, we have 1,000 multiplied by 7, which is the reduced selling price. So we have 7,000. Now we will compare that with our incremental cost. So our incremental cost is the prime cost, 1,000 times 5, and we have 5,000. Variable overhead, and that is 3 times 1/3. 1/3 of that 3, okay, because overhead is 1/3 variable and 2/3 fixed. Okay, so we will look only at the variable overhead, which is 1 actually, multiplied by 1,000 will give us 1,000. Then the additional cost for the special printing of 200. So that will give us incremental cost of 6,200. So we have incremental revenue of 7,000 and incremental cost of 6,200. So therefore, we have an incremental profit of 800. So again, our decision rule would be if all the following factors have been met. We have we have here 800 incremental profit. So as long as there is an incremental profit, we should accept the special sales offer. So therefore, accept the special order. Okay, so we have here another problem. Okay, so we have Fritz Company has been offered a contract to supply 500,000 volleyballs to a large sporting firm abroad at a price of 75 per ball. Fritz's full cost of producing the ball is 80. The normal sales price for the ball is 100 to both distributors and some selected retailers. Variable cost per ball amounted to 70. However, in order to meet the needs of the foreign client, Fritz will have to cut its sales to regular customers by 100,000 balls annually. The foreign client has clearly indicated that it will enter into the agreement only if Fritz will agree to supply all 500,000 of the balls requested. Okay, so the question, should Fritz accept the special sales order? What is the net advantage of the decision? Okay, so again, following our data analysis format, we will look at the incremental revenue. So our incremental revenue, the quantity offered for special price is 500,000. Multiply that with the price as negotiated by the client, foreign client 75. So therefore, we have an incremental revenue of 37.5 million. Okay, so we less the variable cost. So the variable cost in producing that, so we have 500,000 volleyballs multiplied by 70. So we have 35 million less the lost contribution margin. So that is, we will cut 100,000 multiplied by the contribution margin. So take note that we are selling already at price of 100, so less our variable cost, we already have an existing contribution margin per unit of 30. So multiply that with the 100,000 balls, we have 3 million. So therefore, our total incremental cost would be 38 million. Okay, so we compare that with our incremental revenue of 37.5 million. So we actually have an incremental loss of 500,000. So based on this number and based on the data analysis format, we should not accept the special sales price order, because we do not have a net advantage, but it is a net disadvantage of 500,000. So it is a net disadvantage of 500,000. Okay. Okay, so now time for self-check number 4. So Relay Corporation manufactures batons. Relay can manufacture 300,000 batons a year at a variable cost of 750,000 and a fixed cost of 450,000. Based on Relay's predictions for next year, 240,000 batons will be sold at a regular price of 5 each. In addition, a special order was placed for 60,000 batons to be sold at a 40% discount of the regular price. Total fixed costs would be unaffected by this order. By what amount would the company's net operating income be increased or decreased as a result of the special order? So your answer here would be indicating the amount and its effect to the net operating income. So your answer will be the amount and whether it's increase or decrease. Okay, so now let's go to the third business situation, and that is the use of scarce resource in coming up with the best product combination. So our decision question would be, when we have a productive resource that is limited, how do we allocate the use of such scarce resource to maximize profit or minimize cost? So our decision rule would be to go with a product or service with the highest contribution margin per unit of scarce resource. Let's repeat. The contribution margin per unit of scarce resource, it should be given the first priority. So again, we have scarce resources like machine hours, labor hours, shelf space, or seating capacity. So those are some examples of scarce resources. So our data analysis format would be sales price. It's just like a contribution margin format, but we will not stop at the contribution margin per unit of product. So as you can see here, we have sales price of our product less the variable cost per unit of product. So we get the contribution margin per unit of product. So let's divide that by the scarce resource needed per unit of our product. So we get the contribution margin per unit of scarce resource. So again, this will be our basis, no, in our analysis. The contribution margin per unit of scarce resource. So again, we will use this format in all our products, and the product with the highest contribution per unit of scarce resource will be given first priority, but subject to market limitations if there are any. Okay, so again, contribution margin per unit of scarce resource. Okay, so self-check number 5. Question. To maximize total contribution margin, a firm faced with a production constraint should, letter A, promote those products having the highest unit contribution margin. Letter B, promote those products having the highest contribution margin ratios. Letter C, promote those products having the highest contribution margin per unit of constrained resource. And letter D, promote those products having the highest contribution margins and contribution margin ratios. Okay, so we have here our problem. So Viva Company employs highly skilled Filipino artists to produce artworks for sale in handicraft stores. So the artists make large, medium, and small artworks. Okay, so the data are as follows. So selling price for large is 800, 500 for medium, 250 for small. The materials and artist time cost would be 380 for large, 250 for medium, and 160 for small. The hours per piece to make each piece for large, it will take the artist 1 hour to finish a large piece, half hour to finish a medium piece, and 0.20 hours to finish a small piece. Required, rank the production of these artworks by order of priority. Okay, so going back with the data analysis format, we have to get the contribution margin per product. Okay, so we get 420 for large. So we get that 800 less 380 is 480. Medium 500 less 250 is 250. And for small, 250 less 160 is 90. Then we divide that contribution margin per piece, per product, divided by the scarce resource. So we have here the hours per piece. So that's 420 divided by 1. So we have 420. 250 divided by 0.5 is 500. And 90 divided by 0.2 is 450. So therefore, our contribution margin per scarce resource, which is the R, is 420 for large, 500 for medium, and 450 for small. So again, we are talking here about contribution margin, and we know the higher the better. So we have first choice would be, first priority would be the 500, of course. It's for medium. Second is small, 450, and third is the large. So again, if we look at the variable contribution margin, then our decision will be the higher the better. Okay, so we have a continuation requirement. So assuming that market limitations exist as follows. For large, there's no market limitation. For medium, only 300 units. And for small is for 500 units. So required, compute the best product combination, assuming that, again, we also have another limitation. 500 hours of production time is available to the company. So we have a market limitation plus we have a limit on our scarce resource. Okay, so to solve our problem, let's use our data analysis format. Okay, so here we have market limitations. Okay, we have market limitations and we have the hours available for scarce resource, which is only 500 hours. So since with our previous analysis, our first priority should be medium size, okay? So the limitation is only up to 300, okay? So we have 300 units, okay? So multiply that with the hours to make, and that is half hour. So we have, we need 150 hours to make 300 units. So we have remaining 350 hours only. Okay, so from 500 hours available, less 150 hours in making medium. So we have another 350 hours left. So what do we need to produce next? The second priority, and that is the small sized frames. So we have 500 units. Okay, so 500 units multiplied by 0.20 hours. So that will give us 100 hours. Okay, so we need 100 hours to make 500 units as demanded by the market. So we are left with another 250 hours. So the 250 hours will then be used to make all of the large units because there is no market limitation set for large units. So 250 hours. So we need 1 hour per unit. So we will have 250 units. So the best combination of products is 300 for medium, 500 units for small, and 250 units for large. So this is our best product combination. So take note of that. We will be using the analysis of the priority based on the contribution margin per unit of scarce resource. Okay, so we are down with our last self-check for this video. So we have Manico Company produces 3 products, X, Y, and Z with the following characteristics. So kindly read on your own. So the company has only 2,000 machine hours available each month. If demand exceeds the company's capacity, in what sequence should orders be filled if the company wants to maximize its total contribution margin? So please answer on your own. Okay, so thank you for watching and learning. So next lesson coming up will be the part 2 of decision situation, still under relevant costing lesson.